get somewhere, which is actually, it's quite a high place to get to. Getting an investor to be like, bam, I'm going to give you $1 million. It's not like he doesn't think about it, for a little while. And so it's really just outlining a potential deal, which is like a stepping stone to getting the actual investment contract signed. So you get one letter of intent from one investor, and you can use the Me Too strategy, get another couple investors, you get some suppliers with letters of intent, clients with letters of intent, that kind of thing, and then the business starts to take form. And that's really where you want to get to.
Letters of intent for investors rather than for your product.
Yes, but it goes for every aspect of it. So you can look at your business in the center, and you've got investors here, you've got bank here, you've got clients here, you've got suppliers here. You can get letters of intent with all of them, and that's really going to solidify your business and allow you to get operating. Because once you get the letters of intent and you get the contracts, then you're good to go. That's the form of the business, especially for a lot of more tech companies. It's going to be your business is going to be a small filing cabinet with connected contracts, and that's going to be mainly it. Websites, sitting in cyberspace somewhere. So, yeah. Okay. Useful for negotiating other aspects of the firm. So you get a supplier. You can negotiate with the investors. So you've got a great supplier here. This is giving us competitive advantage. Does everyone know what I mean by competitive advantage? It's like what you have over your competitors, what edge you have, and that's going to be interesting to investors as well. And it brings the attention of the investor. It gives them a sense that you've got more than just an idea, because just having the idea is not going to be enough to get an angel investor's interest. Okay, this one I'm leading into the financial statement. So this is kind of I don't know how this is going to go, because it gets into a little bit kind of difficult. Well, maybe not, I don't know. Does anyone know the difference between an income and a cash flow?
I think an income is something what you earn in a month, and cash flow is, I think it's a KPI in the financial model, that you have your revenue, and then you have minus your costs and taxes or something like that.
It's close, but it's like, so an income and cash flow, they can be the same thing. So let's use an example. Let's try to make this as clear as possible. So I've got an ice cream stand, and I go and give ice cream to someone, and they give me €2 for the ice cream. That, in this case, the income and the cash flow are the same thing. So I've made money by selling the ice cream. I get the money, the cash comes in, the cash has flowed from them to me, and then I've given the product, so it's also an income generating thing. But sometimes it's not. So for example, let's say you have like a clothing company, and this happens all the time with clothing companies. You sell the product to the retail store, and they say, great, we're going to buy it, you see what we can do with it, we'll pay you in 90 days for the product. Because they've got to go then and sell all the shirts and things. So in that case, the income is happening right now, because you signed the contract with the retail to sell it, but the cash flow happens in 90 days, because you're actually not getting the physical cash until 90 days from now. And so why is this important? Well, because there's a lot of tricks you can do with your income statements to make it, I sold all this product to my buddy over here, and and he's going to pay me someday eventually, but it's like tricks you can play on investors. So they really need to know not only the income, but the cash flow. So I don't know. Is this clear? Like it's pretty everyone? Okay, cool. All right. So income can be contracted but not yet paid. And then in another case, which is kind of a bit more like what you're talking about, it's like cash flows can come from non-income producing activities. So if an investor invests €1 million in your business, that's a cash flow, but it's not an income, because you don't get any. There's no operating from the business generating any money. It's just cash being given by investors, which is then being used. But you would never put it on your income statement saying, hey, we made $1 million, woo! It's like you just put it on a financing activity, which is going to the cash flow statement. And so we're getting up to like the 3 really important financial statements that are in any business. And one of them is the income statement, one of them is the cash flow statement, the other one is the balance sheet, but we'll talk about that in a second. So, okay. Seems like, so this is the question I kind of just asked. So if you sell 10,000 units at the store, they pay you in 90 days. the income is now, but the cash flow is in 90 days, or any number of things. If you, you owe money, anyways, I think it's pretty quick. So, yeah. Okay, cool. So keeping that in mind, yeah. All right, so the three major financial statements we've got. So I just said them, so I think something to ask that. But, yeah. All right, income statement, balance sheet, statement of cash flows. The investors need to see all three of them. If at first, if you're just talking terms, they don't need to see them. But once they see your business plan, those are the three ones that they really want to see. And income statement is sometimes called the profit and loss statements. Depends, country to country. But they're actually in a very specific order. The income statement always comes first, balance sheet second, statement of cash flows last. And it's because they feed into one another. So I'll show you because I've got them up on this one. And this is where it starts to become boring, everybody. So, all right. We've got in the income statement total revenue at the top. And that is going to be the money coming in from your metrics. So you got this many, whatever's being sold for this price, and it all feeds into the revenue. And so we don't have to go, do you guys want to go through this line by line? We can, it's kind of, yeah. Anyway, so all these things are stuff that gets taken out of the revenue to eventually arrive at your bottom line. So then the revenue is called the top line, and then at the bottom line, you've got your net income.
So is this like an example of something that's happened or a projection?
This is a projection, yeah, and this is just something that I've drafted up just as an example for this. And so, yeah, so you've got revenue, and as you go along, you've got all these different margins. So like gross profit margin is like how much each individual ice cream is sold for and how much it costs. And then you get to arrive to that. So if it costs €1 to make the ice cream, you sell it for €2, it's going to be 50% gross margin on that. And that's just considering that. And the rest of them start to consider more like fixed costs. So you've got things like research and development, which is probably going to be important for the tech companies here. They're going to be developing the product, you're going to have people in like, official looking coats and stuff and like doing this kind of work, and they're going to be making this research and then it's development of the product. And so that's going to be like the programmers working on things. Selling general and administrative is sort of like a catch-all for all the office personnel, administrative secretaries, like anything in there. And like in the ice cream shop, it's like the people working there, they're getting paid whatever they get paid. If one ice cream gets sold, if 100 ice cream gets sold, they get the same wage. So it's a fixed cost. It's the difference between a variable and a fixed cost. The fixed costs are all in this area. You do all these down. Okay, so depreciation and amortization, they are important, but I don't think it's worth to get super into it right now because it's a little bit complicated. Does anyone know what they are? Okay, let's ignore it for the time being. It's just a big, it's one of these things. Maybe I'll do some kind of lecture drag on them, but that's going to be a really boring lecture. So, okay, anyways, there are a couple expenses, there are a couple types of expenses, and then you come down to the operating margin, which is how much the company is, making if it's just operating as a company, without anything to do with the financing structure. So has nothing to do with the interest on bank loans, has something to do with the taxes that are like country-based. It's just the operation of the company. And so that's going to be interesting to investors too. Actually, the margins are quite interesting to investors in general. So you have some summary of this with just the margins that'll already show that you've done some research into it and done some projections on it. Yeah.
What is a good margin in software?
It depends. So yeah, in software, it really depends. It's like the software is going to be a lot higher than an industrial company just in general because the amounts that you're spending to get the amount you're making is much lower.